So one question we get often here is, why are bond prices falling and yet interest rates are going up? And the very simple explanation is that is how it works. Actually, when the Fed raises interest rates, bond prices will go down. When the Fed lowers interest rates, bond prices will go up. And the very basic explanation for this is a bond is a loan to a company, which then pays that money to you, the interest, on a monthly basis. Or for example, let's say you on an annual basis. So you put $10,000 into a bond, you get $1,000 a year in income. So once a year, they pay you $1,000 in interest, right? So that $1,000 in a higher inflation, a higher cost environment is now going to be worth less, because $1,000 doesn't change. If it costs you, $3 for milk and you're getting $1,000, and then the next year it costs you $12 for milk, but you're still getting the same $1,000, that $1,000 is worth less to you. So that's the inverse relationship between interest rates and bonds. Now, in a bond portfolio, over time, the portfolio itself will reset, because as those lower value bonds mature, and the principal is paid back, the new bonds that are coming in are higher yield. So if you're buying a bond fund, that's sort of your inherent protection of that. Is just keep reinvesting your income back into the new bonds as they're coming through the portfolio, and then you'll be able to the income will make up for the losses over time. On the other side, on the flip side of that, is if you own an individual bond and you paid a premium for the bond, and the bond is now dropped in value, at the end of maturity, you're always going to get not necessarily what you paid for it back, you're going to get what the par value of the bond is. So if the bond was issued at $10,000, or say $1,000, you paid $1,250 for it, it's now declined in value to where it's worth, let's say, $800. If you hold it till maturity, you're guaranteed to get that $1,000 back, whatever the par is on the bond. If you were fortunate enough to buy a bond that was discounted, meaning you paid $800 for it, maybe it's still worth $800, or it's gone down to $500. If you hold it till maturity, you still get that $1,000 at the end of the period. So I hope that helps explain why it moves back and forth. It really has to do with purchasing power. If interest rates are higher, the cost of living is probably higher. Interest rates are lower, the cost of living should be lower. And we've been living in a 10-year period now of pretty much 0% interest rates. So unfortunately, this is the pain we have to go through to get back to a normal functioning stock bond relation. Now, the more advanced version of that answer is stocks. What do stocks do? Stocks are not you're not lending money to the company, you're investing in the company. You own voting shares in the company. And so therefore, its price is going to move up and down based on the valuation of that company, or what people perceive the value to be in the future. In the short run, though, if a company goes out of business, you receive nothing. In a bond, you actually have collateral. Typically, bondholders will actually end up with stock in the new company that was formed after the restructure, or there's equipment or something that could be liquidated to satisfy the bondholder's initial investment. Hope this helps.